When it comes to judging the flow of the market, is it the candlesticks or is it the data? The real answer is, it's in the data hidden behind the candlesticks. When you trade, if you start to see these kinds of data that others can't see from now on, your win rate will improve much more than it is now. Starting with today's video, we'll be looking at indicators based on that data. For those indicators, I'll be showing them to you one by one. Starting right now, from this very moment, I'm sure it will be of great help to you. Including the previous video, through 4 videos, we'll share the real whale tracking strategy that we've developed over 2 years of research, as well as the institutional tracking strategy, insights from the CME Bitcoin market, and its key support and resistance zones. Identifying those support and resistance areas in real time and drawing them on your charts. Including powerful tools for this purpose, we'll show and provide all of these to you. Let's get started together right now. First and foremost, as we trade. So, why should we track the movements of whales? Whales, with their enormous capital, move the market's prices. So if we can identify their buying and selling patterns, we can ride those waves ourselves. But the real problem is, how exactly do we do that? How do we find them? Like in the ICT theory, by looking at candlestick shapes and patterns, saying they must have bought here, or guessing they must have sold here, is really no different from leaving it up to luck. There are also a lot of indicators that many traders use. RSI, stochastic, MACD, Bollinger Bands. All of these are lagging indicators, and even though their reliability is low, there are still a lot of traders who use them as their main indicators. I use them too, but I only use them as supplementary indicators, nothing more. Nothing less, nothing more. When it comes to reading the flow of the market, what matters isn't the shape or pattern of the candles, but the data. So what does data mean in trading? What exactly is data in trading? It's the evidence of money moving. In the previous video I shared the hidden volume indicator. You remember, right? It's an indicator that separates the buy and sell ratios within a volume candle and visualizes them. A regular volume candle is marked as a sell candle, but if you look at it with the hidden volume indicator, even though it's a sell candle, you can see traces of buying. On the other hand, a regular volume candle might be marked as a buy candle. But if we look at it with the hidden volume indicator, even though it's a buy candle, we can see traces of selling. What this means is, just like with the candles on the chart, volume candles as well aren't simply about whether it's a sell volume candle or a buy volume candle. And going a step further, just because there's a surge in volume, the price will probably explode too. If you trade with such vague thoughts and judgments, you'll keep experiencing situations where the price goes up after you sell, and the price drops after you buy, over and over again. Alright, let's get started in earnest. When whales make a move, certain phenomena appear in the market. First, a sudden surge in trading volume. An excessive amount of trades compared to the average gets concentrated in a short period of time. Second, a sudden spike in transaction speed. Compared to the previous N candles, the volume and speed of transactions jump by multiples, and these phenomena appear. Third, the impact on price. Even if whales make a single trade, because they trade at a much larger scale than ordinary people, their trades usually cause price changes that go beyond the normal range of volatility. Significant price movements occur. Fourth, the physical range of the candlestick expands. The gap between the high and low points clearly deviates from the average range. Along with these 4 key conditions, we have also developed our own indicators like the hidden volume indicator, and the conditions of several other indicators appear together at the same moment. We determined that the possibility of whale intervention is high. That is our assessment. And the data you see now shows the results of the whale tracking strategy that I just introduced to you. This includes exchange fees and even leverage, all factored into the results. Risk management, profit management, and so on, as well as complete position management, are all handled in the automated trading version. In the case of manual trading, profits vary individually, so the results will be different, right? That's why I always use both manual and automated trading together. With automated trading, if I determine that the direction is wrong, I execute a quick and decisive stop loss without hesitation. Even after several consecutive stop losses, once I start seeing profits, I try to hold the position as long as possible, following a trend-following style. This minimizes risk, can generate stable profits, not as a short-term plan, but as a long-term plan. It's structured so that you can earn profits in a compound interest format. And in the case of manual trading, using the methods I introduced to you today, while watching these data-driven tracking strategies together with the indicators, depending on the market situation. When a signal appears, rather than automated trading, I sometimes get more aggressive, entering positions for bigger profits. But on the other hand, if the market situation is ambiguous, I take a completely wait-and-see approach when trading. What I introduced to you today, the Whale Tracking Strategy Indicator, can be applied directly to your charts so that you can use it right away. And I have posted the link in the comments. If you have any questions about how to use the indicator, and if you're new to using TradingView, beginners ask questions in the comments. So feel free to reach out. I will respond to you as soon as I see them. I will reply right away. All right, let's wrap things up. The traces of whale movements are found in sudden surges in trading volume, instantaneous execution speed, volatility, and the physical expansion of the candlestick range. By analyzing these 4 types of data, you can track them with a high probability. In the next video, we'll look at how the movements of institutions differ from whale movements, how tracking institutions differs from tracking whales, what algorithms built the indicators and automated trading systems, and how institutional moves changed, the approval of the Bitcoin ETF, and what differences there are, along with various supporting evidence. I will show you all of this. Of course, you will be able to that you can immediately apply and use. I will also be providing the institutional tracking indicator along with this. So in the next video, and with a totally new indicator, I will be sure to see you again then. I would like to take this opportunity to express my sincere and heartfelt gratitude to each and every one of you for your valuable time and undivided attention.